welcome to another session of tutorials. This very day from anywhere you might be listening to me. So we continue with our group account, that is consolidation of financial statement. We are looking at parent and a single subsidiary. And so let's look at this illustration. Illustration 2. We've looked at illustration before now. You can please check the YouTube channel and to check for previous classes on this group account. And let's look at this illustration. So on 1st January 2014, Bayo acquired 60% of the ordinary shares of Margaret. The following statement of profit or loss have been produced by Bayo and Margaret for the year ended at 1st December 2024. And, like I've always been telling you, once you enter your exam hall, the first thing you go to is to read the required. What do they ask you to do? Let's go to required. They say prepare a consolidated statement of profit or loss to incorporate Bayo and Margaret for the year ended at 1st December 2014. In other words, you have to prepare a consolidated account for the two companies, merging the two companies together. And like I told us earlier, consolidation simply means merging two or more accounts and together. And that is that for that. Now then you now go, you read through the body of the questions, and your focus mainly should be on the additional information. They said during the year ended 31st December 2014, Bayo has sold 84,000 worth of goods to Margaret. These goods has cost Bayo 56,000 31st December 2014. Margaret still had 36,000 worth of these goods in inventory, held at cost to Margaret. So prepare consolidated statement of statement of profit or loss incorporate Bayo and Margaret as at year ended at 1st December 2024. So this very particular topic has to do with consolidating what is it called? Profit or loss account. The one we have looked at before is consolidation of financial statements, that is statement of financial position of the two companies. So this one is on how to consolidate what is it called, statement of profit or loss. I told us in our first class that if you are doing consolidation, you can be asked to consolidate both statement of financial position, statement of profit or loss, statement of changes in equity, as well as statement of cash flow. All of these ones are subjective to consolidation. So we have looked at how to consolidate statement of financial information. We are still going to do another example on that, and then but let's focus on statement of profit or loss today. And now before we go to the solution, let me quickly state this, that there are three major adjustments that you will just need to do. This is what you must know. Three major adjustments that is required that you must deal with when you are doing consolidation of statement of profit or loss. Number one is when there is unrealized profit. When there is unrealized profit, what you do first is you are going to add the sales value. You are going to you will less the sales value from revenue, that is sales revenue, as well as cost of sales. You are going to less it. Please take note of that. You will, when there is unrealized profit, the sales value, you will less it from both revenue and cost of sale. For instance, in this question that we are looking at, is during the year ended at the 1st December 2014, Bayo sold 84,000 worth of goods. That is the value of sales. This value of sales that is that the parent, the parent sold to, what is his name, man, to subsidiary now. That worth of good, you are going to less it from revenue. You are going to less it from cost of sales. That's number one. Number two, on this same very appropriation that we are doing, you will determine the unrealized profit. Then the unrealized profit that you determine, you are going to only add it back to the cost of sales. That is the adjustment when there is only unrealized profit. For instance, if we check this additional information, Bayo has sold 84,000 worth of goods to Margaret. These goods cost Bayo 56,000. But then Margaret still had 36,000 in his book. So there is an unrealized profit to the group as it stands. You understand now? So you have to determine it. And how will you determine the unrealized profit? The following three steps is what we will use. Number one, first of all, determine the closing inventory. Determine what? The closing inventory. That's number one. Very, very important. That's number one. So number two, now, if they did not give you the percentage of a markup, you have to determine it. And how will you determine it? Because normally, what you're supposed to do is to determine realized profit, what you're supposed to do is just to multiply the closing inventory by margin. If by margin rate, that is, if you were given cost plus, or you are given that the transfer of the goods or the sales of the good is at cost, you understand, or cost plus as it were to the seller. For instance, if they say, as this instance that we are looking at, say it's at cost, they didn't say at cost plus. Assuming it's at cost plus now, you are going to convert it to margin, but they say it's at cost. So therefore, what you need to do in this instance, since they did not give you any rate and for you to use, what you just need to do is, first of all, you determine the profit that was made for the year. You determine the profit that was made for the year, and then you will now divide that profit by the sales value. When you divide the profit by the sales value, you are going to get your margin rate, as it were. And whatever you get, you now multiply with your closing inventory. When we are doing it, you will understand it better. So please quickly reminisce on this, and then we know what to do next on that. Thank you.